Now, the next component of the core ATS software that we're going to cover is what we call liquidity lines. Now, liquidity lines are awesome. There's no other way to put it. So what liquidity lines represent is traders' stop losses. But better yet, because we really don't know as retail traders, even with our technology, I can't tell you exactly where the traders' stop losses are. The market makers know. They know because you send your pending orders to them, but we don't. So what we have to do is we have to estimate based off of the master pattern framework and how it plays out, where stop losses are likely to be and where those areas are that the market makers are going to drive price to accumulate better inventory for themselves or liquidate inventory that they already have for profit. So that being said, let's walk through a scenario right here. We have this contraction point right here. This contraction point had a quick 1-2 leg expansion right here. And then you can see that we got our expansion line right here. So one thing that you also need to know about expansion lines, they have so many different things that they help with and so many ways you could look at them and so many different meanings that are helpful. But another thing that they show us is the swing point between the beliefs of traders. You know that traders operate a lot on the feeling of the fear of missing out. When they see the market move, they want to jump in and chase it because they feel like it's going without them. They don't think there's ever going to be another opportunity, which we know there always is. So they jump in and chase it. So looking at this scenario right here, you could see that price is getting established above this value point right here. See how the market takes off, but see how we have a buy liquidity line down here. So this buy liquidity line, as the market takes off right here, represents any traders that have gotten in long. They've bought this market. This liquidity line is placed at their ultimate breaking point. Now, again, I don't know exactly where the stop losses are, but we know that if the market gets driven back towards this point, all these breakout traders that are trying to buy this are probably not going to stop. They're probably not going to get out all of them right here. They might not get out here, but based off the current market structure, this framework right here, they're going to feel highly uncomfortable. So when the market gets driven up and then gets driven past that, that's where we define their ultimate pain threshold. Now, going back to lessons we have in methodology mastery, talking about the pain and pleasure threshold, the pain threshold is so consistent for the market makers to push because they know that it creates immediate action from traders. Pleasure, when you're in profit, then you have more traders flooding in. That does create action, but nothing creates action that you could count on. Liquidity coming into the market that you can count on, like pushing someone's pain threshold because they immediately want to withdraw. They want the pain to stop, and that usually comes down to them closing the trade that's hurting them. So going back to the example, as the market's coming up, we have this liquidity line defined. The market comes down and drives right through that level and puts those traders into pain that most of them can't handle. And then you can see that the market comes in and it actually accumulates. Now it can keep on going and go into the trend phase, but when we have multiple legs of expansion, usually it could whip back and forth, and that's what it did here. So now as these traders are getting stopped out that were long right here, the moment that we come through that pain threshold, do you know what that also establishes? That establishes the counter opposite pain threshold on the other side of the market for sellers. As we're down below this belief switch point, the swing point here, we get below, traders are now not only getting stopped out from when they bought here, but now they're also getting stopped out and then re-entering the market short because now they think, okay, it's definitely going to break out short. As they chase the market, when we get through that point where these traders' beliefs are breaking, they're closing their trades, new traders are going short, we get another liquidity line at the corresponding swing high point. Why does it go there? Well, you might have some traders that got in early right here. They might be better, a little bit better traders, a little bit quicker. So they sold right here. And you might have some that got right here. And you had a lot that jumped in down here because this is where the worst traders get in. So it would make sense that in this cycle, the master pattern market maker cycle that they control inside here, inside this framework, that we're looking for that trend phase away from this level. they're going to swing the market back and forth to not only get rid of the positions they don't want, but also accumulate the positions they do want. In this case, they weren't done. They're going to drive price all the way back up to that pain threshold. Anyone that sold coming down these daily candles right here on any time frame, when the market reversed against them, they're not going to immediately get out. They might not be in that much pain yet. Maybe these ones down here, but you still got more up here. It's going to push them, and then spike against them to where even if you sold the market back here, you're saying, forget it. Now it's going long. Now they're getting stopped out, and guess what? You got more traders jumping in long, right? So let's talk about the inventory for a second. As these traders traded this short here, as they trade that short, what type of, they're in a sell position, what type of stop loss do they have? They have a buy order. In order to close a trade, you have to buy to even it out, okay? So if you have stop losses in the form of buy orders up here, and then you have new traders coming in the form of wanting to buy the market for a new opportunity. They just want to get in, they want to buy. What does that create an abundance of opportunity to do? Sell the market. The market makers can now take not only the stop losses in the form of buy orders, they can take the new orders coming in the form of buy orders, take the opposite side of those positions for their own book. These are the positions that they want to keep. They fill their book up, their basket with all this good inventory, and then what do you know? The market comes down, they're done with their accumulation, it spikes, we get this aggressive move through value, and then we're off to the races, and that is their profit cycle right there as we get back through value. And then it starts over again right here. That's your 3 market phases over and over and over again. So going back to the liquidity lines represent those breaking points, those pain threshold belief points where traders, regardless of if they even have a stop loss, you might have some traders that were trading the short and say, I'm tired of getting my stop hit. I'm going to think, but I'm just not going to run stops. It really doesn't matter. It doesn't matter, because if you're short here and then the market is now here, you're feeling pain, you're uncomfortable regardless if you have a stop loss or not, and you're going to want to exit that trade manually even without a stop loss. So that is the purpose of liquidity lines. That is what they do, and these lines, as you can see, hold true for a very long time. Even in this cycle we see right here, we had our trend phase come down all the way down to right here, had a few more trend phases come down through. But this liquidity level is still ripe for harvesting later on. So as you're trading these cycles up, we even have a different directional bias. We're looking for the market to go up. We can use these levels to close out positions because we still know that there's still liquidity ripe for harvesting. Traders never close trades in profit, or it's very hard for them to do it. And it all comes down to the most important lesson that I can teach you from all the years I've been doing this. Pain and pleasure controls the market. Even these traders that thought that they were very smart from this origination point right here and shorted the market, and they're just thinking they're getting richer and richer and richer on paper. As the market goes back against them, they're in disbelief. They're like, no, it can't be happening. It's still going to go. It's going more and more against them, more and more against them, until it goes all the way past that original belief swing point from back here and pops their stop loss to their horror and disbelief. Now that you're an ATS trader, you can see how this is a map of beliefs. It's a map of market maker cycles. This is the high road view. This is you looking at not only retail buyers, retail sellers, market makers, banks, the institutions. You're looking at all of them from a bird's eye view, and you're seeing how the chess pieces are moving so that you can take action. That's what Action Threshold software is all about, is letting the story unfold until you understand what's likely to happen. You have a low risk entry, you figure out what the banks are doing, and then you join in and trade with them rather than let them take advantage of you and be wondering why you're always getting stopped out. That all stops today when you start learning this methodology.